Thank you. I'm glad to be taking over this seminar series this year, and we're starting off with our presentation. Happy to welcome Dr. Akbar Marvasti. Dr. Marvasti is an economist at the Southeast Fisheries Science Center, so this is actually a great opportunity to hear from the economics side of the Fisheries House and how some of their work overlaps with stock assessments. Dr. Marvasti will be discussing some work on using economic data to get estimates of applied biomass and stock abundance, and we'll also touch on the never controversial red snapper stock. So with that, I really like to welcome Dr. Marvasti.
Thank you, Abby and Lisa. I'd like to share with you the content of a paper that I had worked on with Sammy, one of my former colleagues and friend. It addresses an issue that is of interest both to economists as well as marine biologists, the issue of stock assessment and whether any market indicators could be used in estimating the size of the stock, which is unknown. So the title of the paper is Minimum Information Management and Price Abundance Relationship in Fisheries. I'd like to note that the paper has been recently published in Canadian Journal of Agricultural Economics. In case anyone has interest in the paper, which has a lot more details about the work done, you could read this paper from the journal. So the objective of this research project is to explore the information content of dockside prices, and by prices I mean price of inputs as well, and fishing costs in estimating the stock, the abundance of a stock. Our major findings are that there appears to be a link between the stock biomass of red snapper in the Gulf of Mexico. This is the species that we have selected, which is one of the most controversial species in the Gulf of Mexico. Between red snapper and market indicators, including ex-vessel price of a red snapper, cost of obtaining the right to fish. This is when we are under the IFQ program, be it we are under IFQ program, not the common quota, of course, and the price index for inputs. So to provide a bit of background, actually the first slide on the background is something that is common knowledge for marine biologists, that is biometric stock assessment, which is based on fish population surveys and other variables such as length of the fish, age structure of the fish, weight composition of the fish, tag and recapture data, and fishing effort as main variables, is a very complex process and takes sometimes 2-3 years, I think, to complete, if not longer. Involves a few scientists. The process, as a result, is expensive and infrequent. And of course, not to mention that stock assessment is not done actually for all the species. Only major species typically have a stock assessment. Also, the fact that there are occasionally gaps between the projections and the biological models that need to consider some shifts that could be the result of migration of fish species or environmental changes. So the argument here is whether we can use either as a complement or as a replacement in the case of the species that are not of primary concern and have no stock assessment, it could be used there to indicate the size of the biomass, stock biomass, or direction of the changes in the biomass. I must note that what is done in this paper is really a proof of concept. So to my knowledge, this is the first such a work that is done in renewable resources. Therefore, it's fair to say that the bar is not very high, as we try to demonstrate that it's possible to do this given lots of complexities that exist in the market. That is, when I had the initial thought on this paper and sharing it with some colleagues in the past, the common criticism was that, well, price of fish species in the market are affected by a large number of variables, really. So it is difficult to draw these conclusions with regard to the size of the stock, which is itself an underlying variable typically for landing, but even that connection itself really is not always linear, nor is it necessarily positively correlated as the fish species go through various stages, right? So the reason that this caught my attention, as I'm not actually a trained fishery economist, and I'm a general economist, so my training has been wide in the area of economics. And I remember in graduate school, I had learned about the long-term trend in non-renewable resources. I'm talking about minerals in the specific, and how the literature has addressed that using prices of minerals as indicators of the increasing scarcity of the minerals. This work initially was introduced for non-renewable resources by Hotelling in 1931. And there has been many studies since then, including Slade in 82, Maazami and Anderson in 94, and Wagner in 2007. And the results have not been always very straightforward and consistent with economic theory, as established by Hotelling, where he argued that for non-renewable resources, the shadow price of the resource stock, which is equal to the market price minus marginal extraction cost, serves as an economic measure of resource scarcity. Now, assuming that the marginal cost of extraction is constant and there are no technological progress, the prediction was that resources should have an upward trajectory, even though initially they could be falling because initially when they discovered the minerals and their uses, there could be more discoveries of resources and things of that nature that may lead to a downward trend in the price of the stocks, in the price of, I'm sorry, minerals. So, but the findings in reality demonstrated that this pattern is not always found. And among explanations there has been technological advancement in extraction of minerals. That includes situations such as, say, fracking in extraction of oil, that the type of deposits that previously were not considered as extractable becomes extractable. So the market, if you remember, was a couple of decades ago or so, maybe glutted actually by the output extraction of non-renewable resources such as oil, and so the price would fall as a result. So one of the surprises that when I joined NOAA I had, and it's still when I go to economic conferences, not necessarily fishery economics conferences, is the concept of effort. And my economic colleagues would relate to that because in the field of economics, that's a concept that is used in economic literature on fisheries actually as well, but also biologists use that, and it's a bit complicated for us economists because it includes a bunch of variables. It's a composite of variables made of crew, size, trip duration, which are variable inputs, and their costs would be variable costs, as well as fixed inputs and fixed costs such as horsepower and vessel length. So that's a confusing concept, and not to mention that they are not informed by relative prices. So there is no price of input in the effort. So Arneson wrote a paper in 1990, and in there he argued that the ITQ system, individual transferable quota, is a minimum information management system, which allows management to achieve efficiency in a decentralized market system. So there, the piece of information that is managed in the market is really price of allocation shares. Interestingly, Arneson wrote a few papers later actually criticizing the shortcomings of the ITQ system. But that idea about the minimum information management system remain, and I don't recall if he has criticized that directly, but there are some complexities obviously in the system and efficacy of the ITQ system as a whole. But that's not the point here. The point is whether, as related to this research, whether market indicators could be beneficial in estimating the level of a stock or their movements. So I pointed out earlier that biometric stock assessment methods are complex, expensive, and infrequent as a result. And the point is that economic variables are, on the other hand, readily available typically. They often have high frequencies. Stock assessments, unfortunately, there are some discussions of introducing seasonality in stock assessments, and may be estimated on that basis, at least if not monthly. But so far as much as I know, as far as I know, it is really on an annual basis. That is very infrequent basis. So we wonder if we could interrogate the data that is frequent and inexpensive, because typically is freely available, to find some information about the size of the stocks. We followed a couple of broad approaches. The first one is based on simulation using trying to estimate the implied biomass from the first order condition of Nash equilibrium profit maximization, where the output, I remember that I could use my cursor, where the output is a function of the catchability coefficient, the biomass, and the effort, with the alpha coefficient that measures effectiveness of the effort. This is a Schaefer production function, very standard in economics of fisheries. And we consider the fact that in the case of red snapper, period of 1993, our data basically goes back to 1993, not any earlier. Not the stock assessment data, actually. The stock assessment data could be obtained going back another 2-3 decades at least, from what I know. But the cost data on fisheries and landing data that are reliable through a logbook system begin in 1993. 1992 data is not very reliable. So, and then in 2007, ITQ system was introduced. So the data for the ITQ period is from 2007 to 2017, which is the end of the time period in the analysis of this paper, because we started the paper a few years earlier. We also do sensitivity analysis based on the wide range of values for output elasticity of effort, that is the alpha. So once again, the implied biomass estimation is based on this Schaefer production function, and these are the variables that are included in the Schaefer production function. It's the biomass, effort, and the return to effort coefficient, the alpha, which is smaller than 1, the decrease in return to the effort. And if it happens to be equal to 1, then we have constant return to effort, assuming that catchability is invariant, that is, no technological progress occurs. So the two-step profit maximization based on Schaefer production that would help us to look at the Fisher's decision to maximize trip-level profit. And that trip-level profit is defined as 1 minus L, which is a share of the revenue going to the labor, assuming that it's a lay system. Of course, the actual fishery for red snapper or reef fish fisheries is less straightforward with regard to that, because some of them are owner operated. They are not necessarily operating with a hired captain. So you can assume that there would be earning of the captain in that case would be twofold. That is, they receive some money because of their work as a captain, as well as their work as the owner of the vessel and permit holder. So this equation is basically telling us about the trip decision profit maximization. Well, W is the price of unit of effort, and E is obviously the effort. And then we have a profit maximization, not for the trip, but for the entire year, which is specified as T pi sub T minus CT, where T is the number of trips that the fisherman would take during a year. Now, C is a fairly broad concept of the cost during the year, which includes the maintenance cost, wear and tear of the vessel, and general risk-taking behavior, as we have done some estimates of in the past, occupational injuries. So these are mostly a form of fixed cost. So this shows the mathematical formula that are derived for unregulated open access or the common fishing quota system with trip level catch limits versus the ITQ system for the landing and for the size of biomass. So basically these are just used to grab variables that are relevant to the estimation process. So what you see on the screen now is the size of the biomass estimated for a period of 93 till 2017, where size of alpha, the optimum size estimated, turned out to be 0.86. And this is compared with the CDAR 52 stock biomass for age 3+. In our entire analysis, we have used age 0+, that is to total biomass, as well as 3+. So here we see that in this estimation, we selected this here because of its closer proximity to the age limit of the fish species that could be landed. And it was interesting that the simulation, the implied biomass matched well until about 2012. And then there is a divergence, which is pretty wide. And they go totally different direction, where the CDAR is a continuously upward trend showing recovery since early 2000s. Of course, they started the IFQ system. That is background is all in the paper. And we being in the Southeast Fisheries Science Center or different other areas, typically it's well known that the history of management for red snapper, that the concern rose in early 1990s, where they had the common fishing quota, and then later in 2007 there was individual fishing quota that was instituted. So even after these two were instituted, still the match between the two is pretty good. Not as good after IFQ was instituted, but from this point on, there's a big divergence, and we were puzzled, and we still really don't have a clear answer as to what has happened that might explain this outcome. One thought was our model is based on profit maximization, and the question was whether really the fishermen are all profit maximizers. We realized that maybe a sizable number of vessels behave in that fashion, but there are also some component of fisheries that may be based on subsistence, level of earning or income. So they are not necessarily profit maximizers. They may operate even if they are barely break even or even losing, because they may exist in the fishery because of cultural factors or history in their family, and therefore the standard profit maximization may not apply necessarily. Though I'm not sure if this is really the big portion of the fishery. Also, we thought about possibility of inaccurate cost data. Based on information that I have, the cost data over time has improved. So earlier cost data, maybe in 1990s, sometimes not as accurate. But we also dismissed this as being the primary reason. The only thing that had some traction in our thinking about this is varying catchability, where it's assumed in the models to be constant. Even in our simulation model, we assume it to be constant, but it may have progressively decreased. And one thought that occurred to us was the delayed impact of Deepwater Horizon oil spill. And we found an evidence of that in a paper written by Ainsworth in 2018, fairly current paper, where they argued that there was a decrease in the biomass of large reef fish, which has affected the catchability. So maybe that is a factor that has lingered on since the Deepwater Horizon. The second approach uses more standard time series analysis. Here I've developed this chart to show visually that management is obviously concerned about the information about fish species, particularly about the stock size. So I pointed out about the issues in developing the traditional methods of estimating the size of the stocks. But then comes to our market use of the signals, and at least creating advanced notices for some stocks that may trigger alarm that perhaps this stock needs to be reassessed. These are, I mentioned some complexities that has led sometime in the past to some criticism by some of my colleagues regarding this type of analysis using the price information in the market. That is, we realize that there are a bunch of really variables out there that could influence the price of the fish. And these are, if you imagine simple demand and supply curves, the demand and supply, both of them could continuously shift up and down due to many different reasons that lead to the change in price. So then to imply that the change in price is the result of change in landing, which is linked to obviously the size of the stocks, and as I said earlier, not always necessarily consistently or in a necessarily positive fashion. But what we have done, as you see, is to control for as many of these variable shift factors as possible, especially on the supply side. And these include also imports, the fishing efforts, allowable catch, individual fishing quota. At the end, as we see progressing in this second method, some of these variables, because of the limitations on the degree of freedom in the models, had to be dropped. So we did not end up using all of them necessarily. You see that in the system of equation description. For example, imports is one of the variables that we ended up dropping, or the size of fish, the size limits for fish was another one that we dropped. But the biggest challenge in this estimation method was really mixed frequency of the data. And we use several methodologies such as VAR, MIDAS, MF VAR, and VEC even to arrive at this minimum information outcome. So let me just make an additional comment about this mixed frequency data situation. Our data set runs from 93 to 2017. So in terms of number of years, that's about 25 years, I believe, which is not a very long time period. Added complexity is that there are several variables that we are using, and these variables do not have the same frequencies. So stock abundance data are annual, while most of the other variables are actually monthly. Of course, some of them are available even on daily basis, such as landing. So we have these mismatches with frequency of the data, which makes estimation process very complex, difficult. One method typically is to an aggregation of, say, monthly data into annual data. And the problem is that we lose information in the process, because during the year there could be changes, fluctuations in the level of that particular variable. So it could be subject to seasonality or other variations. Another complexity that exists is the fact that there are government regulations that complicate this process. The ITQ system, the catch limit, size limit. So these are all added factors. I'd like to mention here that one of the issues that we noticed off the bat was obviously the studies that have been done in the past on use of price as an indicator of scarcity of resources have been based on minerals. Minerals are very different from, they are non-renewable resources, and they are very different from renewable resources such as fish. So one thing, by definition, the stock of fish at each time can potentially grow, where its growth is dependent upon the size of the stocks. So there is a dynamic there. Such a dynamic obviously doesn't exist in the case of non-renewable resources. And also a bunch of regulatory factors typically exist for management of renewable resources such as fish, which are absent in the case of non-renewable resources. So we recognize the challenge. Once again, this is a proof of concept that maybe over time with other studies, it could be improved upon. So the variables that we use are price cost margin. And by cost, I'm referring to the cost of the permit, the cost of ITQ cost, allocation price in the market. And then we use cost index. That is an index of price of inputs made of diesel fuel prices. And then we use the general CPI for remaining third. That would be covering the cost of other inputs. Landing, IFQ dummy variable, price of grouper, as either you perceive it as complement or substitute in the production, as it is also a variable possibly in the consumption. And then allowable cache limit and imports. Again, we were not able to use the imports in the final analysis. Several different methods have been used for estimation purposes. The standard bar, vector autoregressive method. In this method, we use annual aggregate data. Bayesian bar, we use, again, annual aggregate data. Then we use some mixed frequency data methodologies, including the MFB var, that is mixed frequency Bayesian var, and mixed data sampling, the MIDAS. Both of these methods use mixed frequency data, that is, use annual as well as monthly data. And finally, we use the standard VEC model, vector error correction model. So the variables that you see are specific variables that actually we ended up using in the models. That is price cost margin, that's the price of output minus the cost of allocation share, cost index, landing, ITQ, grouper prices. A problem that we faced was over-parameterization in some of the models, such as VAR, BVAR, and MFVAR, and soon we had to abandon them. They are reported in the paper in the appendix. They produced poor results, not surprisingly, because there were too many parameters to estimate and limited degree of freedom. So our important methodology used for estimation are MIDAS and the VEC models. With the MIDAS, we use polynomial distributed lag of order 2, and then as I show you the results, the PDL coefficients are the key variables because they capture the dynamic effects of changes in the price and how they capture the changes in the stock abundance. And also, I show you in the table measures of predictive accuracy. That is, once we estimated these models, then we went to the forecasting, because a good judgment about the accuracy of the model is how it allows us to do forecasting and how accurate the forecasts are. There are two common methods of forecasting. One is in-sample forecasting, which I haven't reported the results in the PowerPoint presentation slides, but they are in the paper, and actually they show a pretty good overlap with the actual stocks. However, it is not a commonly used tool to judge the predictive accuracy of the estimates. The out-of-sample forecasts are superior. So first, going over these estimates, this is for Bio 3 biomass, 4 specifications of the model, and here you see system variables, model 1 through 4. It starts with very simple, naive version of the model using the stock biomass and price cost margin, and then we add the cost index, and then next one we add the ITQ, and the last one price of grouper. So you see that in the in-sample forecast, we have the mean absolute error, which is probably the best measure among the 3 that we have used for forecasting. Shows that actually model 4 is producing the most accurate forecast. Also, of course, for the model itself, initially we could use the AIC, is a common measure of fitness, and that also points to model 4. However, the out-of-sample forecast is favoring model 1, which is a very naive version. But still, model 4 is performing pretty well. That's why the graph that I'm going to show you would rely upon model 4. Now you see some similar outcome in terms of bio 3 estimates, and again model 4 is a superior forecast, but model 2 in this case providing a better out of sample forecast. By the way, I want to point out here that not all variables, because of limited space here, are reported, their coefficient estimates. That's in the paper if you like to look them up. I reported the variables that are the most important, their key variable to get the message across. That is polynomial distributed lag of order 1 and 2. These coefficients here, as you see in various specifications of the model, are fairly stable and highly significant. This is for order 1 and this is order 2. Order 1 shows a negative sign for the coefficient, which basically indicates that the price cost margin has inverse relation with the size of stock biomass, which is the basic message that we are trying to convey. Of course, this is an immediate or short-run reaction of or correlation between the two variables, where in a longer horizon, we see a positive correlation, which is also significant, but note that the magnitude of the effect is substantially less. However, the long run needs to really add polynomial distributed coefficient of order 1 and 2 together. So if you add these coefficients, all of them together, 1 and 2, you see that the negative far exceeds the positive, suggesting that the long-term effect is negative actually, validating the argument that we are making. You see similar results here for bio 3. Here are the forecasts for out of sample. This is for bio 3, and it's out of sample forecast for 2 periods ahead of time. So you see this is the actual versus forecast for the first period, that it would be 2016, and then this is 2017. And 2016 completely overlaps with the actual data. 2017 deviates a bit. This deviation is also observed in biomass 3. It is common in the field of forecasting that as the time horizon expands, the forecasting becomes less actually accurate. So it is not unusual that the forecasting accuracy in time period 2, as you see here again, is more. That's a gap, much bigger gap than this. As a matter of fact, if you watch weather forecasts yourself in the evening, you notice that what the forecasters are suggesting and the observation that you would have in the following days would become less accurate as the time horizon expands. The final method that used in the estimation is the VEC model, vector error correction model. We went through the standard methods of testing for unit root, then finding co-integrating vectors which are necessary to move on to the next stage. We estimated normalizing co-integrated vectors, and then did a forecasting. And the difference is that in the case of forecasting here, we could do also confidence intervals. This is the result of this, the forecast from the VEC models. Again, the key variable here is the PC, as you see, is negative and highly significant. And then we have auto sample forecasting. I'm kind of running out of time. I want to leave some time for questions and answers. So let me try to wrap this up. So this is the auto sample forecast for bio 3. And this is the confidence interval. VEC model allows me to estimate also the confidence interval. The forecast time period 1 overlaps completely. Time period 2 has a gap, but both of them are within 95% confidence interval. And the outcome here is repeated, only a little bit less forecasting accuracy for Bio 3. So our conclusions are that here we have explored the economic and ecological relationship in fisheries and established that there is indeed a link between the market indicators, particularly price, and non-renewable resource stock, a non-renewable stock. This is an example for red snapper. And this is consistent with the finding from non-renewable resources. This study also shows that we can infer actually unobserved stock changes from observed prices, which is consistent with the spirit of minimum information management. So among your findings were also that the simulation models that we use found some inconsistencies with implied, the CDR 52 and implied stock biomass since 2012. So we had some explanation, but you guys may come up with other suggestions. And also time series data analysis used in MIDAS and VEC. MIDAS was using mix of time annual and monthly data, where VEC used annual data. So it demonstrated the link between biomass and ex-vessel prices, as well as input price index. Out of sample forecasting indicated that the forecasts were within 95% confidence intervals. I sort of have a couple of questions and not a complete answer for them. One is, which measure of stock abundance is more forecastable, and why? And in discussions, questions that follows, I would be happy to listen to any suggestions. Our thoughts were that Bio 3 should be a better measure or better version of stock assessment, better indicator, because it's closer to the size of fish that could be landed. But it turned out that here actually Bio 0 provided better forecasts. Another one was, we are aware of the Hart Research Institute stock assessment that was contradicting the stock assessments done by Southeast Fishery Science Center. And of course, there were some explanations about the geographic areas that were apparently in shallow waters and were not sampled, at least one of the explanations. And then I was initially wondering whether that could be, our approach could be applied to the study done by the Hart Research Institute. And then this is something that I'd like to get your input on as well. And reading it, I learned that they really do not forecast the size of the stocks over time. It's just a snapshot of actual stocks that are present, and then they compare it with the stock assessment done by Southeast Fishery Science Center. So it is not applicable as far as I know. This is my email address in case you need to send me any email for various reasons, including questions that you may have that you didn't get a chance to discuss here. Thank you very much for listening to me.